President of our Board of Directors, Deborah Fisher of Berkshire Hathaway Real Estate Services, Kate Bluff.
It is my pleasure to introduce Sandy Lincoln, who is the Chief Market Strategist for BMO Asset Management US. Sandy joined the firm in 2008, and he currently serves, as I said, as the Chief Market Strategist for BMO Asset Management US. In that capacity, he is also a member of the Investment Strategy Committee, which provides direction regarding asset allocation for clients spanning institutional to retail investors with assets that total over $150 billion. Sandy is also one of 3 portfolio managers on BMO Asset Management's managed asset allocation portfolios with $4 billion in assets. Sandy brings more than 35 years of investment management and consulting experience. 40? Okay. Full disclosure, 40. Including president of W.M. Mercer's Global Asset Consulting subsidiary. He was chief investment officer of Kemper Corporation, where he oversaw their $50 billion portfolio of mutual funds, and he was chief operating officer at Lincoln Capital Management with $60 billion in managed assets. Sandy holds a BA from Valparaiso University, as well as an MBA in finance from Loyola University. Additionally, he's made regular appearances on CNBC, CNN, WGN, and Bloomberg, and has been quoted in such publications as Wall Street Journal, Investors Business Daily, and the Chicago Tribune. Please welcome Sandy.
Thank you, Deb. Okay, time's up reading that. Questions? All right, my name is Sandy Lincoln. I have 40 years of it. Yeah, 15 years doing this and 40 plus years in the industry. So, and I'm always amazed because every year I think it's going to be really hard to come up with something to talk about, and every year it's not that hard to come up with something to talk about. So today we've got a lot of stuff to cover. Isn't this a great screen? This is new here. I don't think we had this screen the last time I was here. Everybody see it okay? It's too bad if you can't. So, you know, if you look at what's going on around the globe, and we will give you a sort of a global. So this is the kind of stuff we're going to cover, but basically we're going to spend most of our time talking about the United States, but we will give you a little global tour as well. We can't avoid that, so we'll talk about China, we'll talk about Europe, emerging markets, connect the dots around the globe a little bit, if you will, and we're going to get kind of granular on the U.S., so you'll end up with a fairly good understanding, hopefully, of what's going on in the U.S. These are some worldwide events, and national events, obviously, as well, and basically, if you look at them, they should look familiar to you. Because in prior years, we had almost the exact same kind of events affecting the way the markets were performing. So if you look at this, Europe was a concern last year, right? China was a concern last year. Japan was a concern last year. Emerging markets were concerned last year. Worldwide impact of what's going on in oil prices, that's a little bit new this year. Currencies, obviously, the euro's weak, dollar's strong. We had this wonderful bull market. I don't know if anybody's noticed. It's been like 6 years, so that's been kind of around for a while. And obviously now the Fed that sort of stopped spoon-feeding us money is deciding when to start raising interest rates, so that's kind of up on the ladder. And this is kind of standard. When you have a long period of years where you've had a good year, another good year, another good year, much like we had in the 90s, 93, 94, 95, 96, 97, 98, 99, usually events of the prior year have a lot to say about what's going to happen in the next year. And we have a statistical term in our industry that we use for that. You ready? Hello? Okay, you are. Okay, just want to make sure you're ready for this. It's called the lagged correlation coefficient. Everybody. Lagged correlation coefficient. Excellent. This is a fantastic term. Amazing term. Like if you're at a cocktail party and you use this term, you can drink alone the rest of the night. And all it means is that recent events have something to do with future events. And that's what we're seeing. Most of this stuff we've seen before. So if we play this through and we just talk about one of the new ones, How about this one for a new one, right? Oil. We were struggling with oil at $110 a barrel, $112 a barrel. Now suddenly we look at oil, and oil has fallen 55%, not 45% here, but it fell 55%. And the IMF estimates that this oil decline is worth about a full percentage point to our total economic output. A full percentage point. The total economic output of the world is somewhere around 70 or 80 trillion dollars. It's expected to grow by about 3% next year. So imagine, or this year, imagine adding a full percentage point to a 3 percentage point growth rate. That's a heck of a percentage increase. And why is that? Because it's really good for consumers. Falling oil prices, isn't it great to go to the pump? I just came back from a trip in Central America. I was in Madison, Milwaukee. Wait, what did they serve for lunch here? What happened? What happened? I know marijuana's been legalized, but let's not get carried away. Those brownies must have had something in them. So yeah, I'm going to the pump, right? And it used to cost me a fortune to fill up, and I'm paying like $2.10 a gallon. So it's phenomenal for consumers, and it's phenomenal for consuming countries that consume a lot of energy, like Japan, like South Korea. It's a huge tailwind. So if you look at it on the basis of who gets helped and who gets hurt, producers get hurt. That's who gets hurt, the people that produce the oil, because they're not able to get $100 a barrel. They're only going to get $40 or $45 a barrel. So they get hurt, and here are the big producers. And of course, the biggest is Saudi Arabia. And Saudi Arabia has a huge economy in terms of its oil generation. It's almost all of its economy. They're going to get hurt. And Mexico, it's sort of the smaller end, but they're a producer as well, so they get hurt. So you can see this is a pretty significant. Now, how many of you have money invested in these countries? I don't see any show of hands. The producers basically are places where we don't have a lot of investment going on in those countries. We're invested in a lot of other places like Japan, like South Korea, like China, but not in the big producing countries. So producers really get hurt and consumers really get helped. For example, Japan as a country, South Korea as a country. All of us as consumers, 70% of the U.S. economy, suddenly we're paying $2 less a gallon for gas. That's worth, depending on what kind of vehicle you're driving and how much you drive, some estimates are that might be worth as much as $1,000 or more to a customer over the course of a year. So it's a pretty significant impact. So this oil is a real tailwind on the consumer side of the equation. If we play that through to the United States and look at a couple of other developments in the United States, so we have this sort of global tailwind. Now we're going to talk about a couple of local tailwinds, local meaning the United States. And if we look at the United States, we've got some tailwinds that are going on as well. And one of them is consistent/persistent growth in jobs. A huge positive for this economy. So if we go back, and by the way, economists like to see, in a growing economy, they like to see about 200 to 250 or even 300,000 jobs being created by the private sector every single month, okay? We obviously weren't doing that in 2008, 2009, 2010 as we were coming out of the recession, but let's take a look at the last 3 years. This is 2012. And that dotted line in there is that Maginot line above which economists like to see the job number. Well, we ticked it, and we got just inched over it a couple times during 2012, but it was kind of erratic, and for the most part, we stayed below it during 2012, and people were mightily concerned, including Bernanke at the Fed, about the lack of job creation. Well, here's 2013. We cross over the line a few more times, but now take a look at 2014. Holy smokes. Technical term learned in graduate school. Basically, a phenomenal level of job creation and very consistent and very persistent. And a couple of other sidebars. The job creation is getting broader. It used to be in 2012 and 13, congratulations, college graduate, we found you a job at Starbucks. Now we're starting to find that it's not just hospitality and leisure. It's manufacturing, it's services, it's healthcare, it's education, and eventually, not yet, government will start to come into this equation as well. Right now, the government, state, municipal, and federal, are net drags on employment numbers, but so far, this has been a very consistent record. And of course, that's great for consumers too, right? They're getting a job. People, for the first time this past month, who had given up looking for work, have decided to try and come back into the workforce. We'll talk a little bit more about that in a minute. So have oil as a tailwind. We have the job creation as a tailwind. Let's just talk about you and me. And by the way, pretty phenomenal, all of you. I want to thank all of you for the spending you're doing, particularly buying wine with a cork in it. I'm feeling a lot better at night. Okay, good news for the consumer. Let's look at a couple of these. One is, these are all wage and unemployment numbers, and as long as, and a little of an unusual thing called the quits rate. Wage and earnings, we didn't get the newest number that we just got on the far right-hand side. You want to see wage growth at 2.5 to 3. We just got a new number this past week. It's 2.5%. Okay, so salaries are starting to grow. BMO just put their arm around me the other day at the end of the year and said, Sandy, congratulations, you did a great job last year. Here's your 2% salary increase. Ah, it felt so good. But at 2.5 or 3, Janet Yellen starts to say, this economy is getting better, wages are getting traction, more people are getting employed, more people are looking for work, unemployment rate is coming down. The quits rate, which you don't see very often, not a common number, I like to give you something kind of out of the ordinary. Quits rate is you and me saying, you know what, I've got a job, but I want to change jobs. So I'm going to look at the 4 million jobs that are posted and open on the internet, and if I find one, I'm going to move from X to Y company and make that change if I find the right deal. That number was actually 0 for a long period of time because in 08, 09, you were just thankful if you had a job. You were hanging on with your fingernails. And now, suddenly, we're seeing people actually say, hey, I'm going to look elsewhere for opportunities. Now, the big coup de grace for the consumer are these 3 numbers: retail sales, disposable income, and the average price of gas per gallon. So the average price of gas at the bottom has gone down dramatically. Disposable income is up dramatically, even more than gas would explain. Why is disposable income up? It's not just gas. Many of you in this room are involved in real estate. It's people that refinanced their mortgage, and they went from a 4% mortgage, to a 4% mortgage, from a 5 or 6% mortgage. I had a young waiter at a hotel one morning who told me that he'd been waiting tables for several years. His wife was a school teacher. They've refinanced their home 3 separate times. It's produced over $400 a month of free cash flow. It's not the same as a salary increase, but that disposable income has been a big help. So the sideline here, so we got good news for oil, we got good news on jobs, we got good news on the consumer profile, and by the way, I didn't set aside a slide for this, corporate America is in phenomenal shape. Corporate profitability, corporate profit margins are the highest in the world, and they've been sustained. Corporations are increasing dividends. They're still doing merger and acquisition activity. They're spending to revamp their plant and equipment. So there's a lot of good stuff going on in the corporate side of this equation as well. So if we play all this through and say to ourselves, with all that good news, isn't the Fed about to do something? And the answer is yes. And the question is, how soon are they about to do it? Now, we call this Fed tightening. That's our technical phrase for it. It's when the Fed starts to move interest rates up. And they move interest rates because, anybody? The economy is getting stronger. And they get worried that the economy is going to go too fast. It'll trigger some inflation. So they start inching up the interest rate. It's called Fed tightening. We've had a couple of prior examples of it. The first one is in '94. And we had another round of it in 2004, and we're kind of waiting right now to see whether the Fed's getting close to doing it. We're going to look at a series of metrics here, and this is kind of technical, but it'll tell you the generalized point. Unemployment's up here, CPI numbers, both what we call the core CPI and the PCE, personal consumption expenditures, and average hourly earnings. And you'll see the current reading. If we look at unemployment, we're at 5.7. Well, the Fed started to tighten the last time, and unemployment was at 5.6. And the prior time they tightened, unemployment had only hit only 6.6%. So look, by that measure, it looks like it could be potentially pretty quick. CPI numbers, yes, our inflation numbers are running lower, but those are starting to tick up with that inflation number. They're probably closer to 2%. So they're probably getting close on that. And hourly earnings with the new number that we just got at 2.5, they're right there for that. And then if you look at GDP growth or leading economic indicators or how much the gain of the S&P since the offsetting recession, you can see all of these numbers suggest the Fed should be ready to act. And our prediction is, and it's just that, is it'll probably act in September. But the news has been so good in the last few days and weeks that it's entirely possible they'll act in June. Why do we care? What does it do to the stock market? What do you think happens when the Fed makes that initial move to raise interest rates for the first time? Actually, stocks like it because the Fed is confirming that the economy is, in fact, improving. And the second move, stocks also like. But when you get to move 3, 4, 5, and 6, usually it means the economy is getting even better and the Fed's getting progressively more concerned. Stocks kind of turn their tail when that starts to happen. But we could easily have a year or more, maybe even 2 years or more before we get to that point. So while pretty granular information here, I just want to make sure that, that your stomach didn't put you totally to sleep. This would do the trick. Okay, so now how's all this played through the common stocks? Well, we all know we're having a great time in the stock market. It has been really fantastic, unbelievably good almost. Here are a bunch of indexes: S&P 500, Dow Jones, Russell 1000, which is big companies, Russell 2000, small companies, and our technology and bio and life sciences companies in NASDAQ. Look at these returns for 2014. We're up 14 or 15%, in spite of all the noise that we heard out of Europe, in spite of all of the concerns about China and the emerging markets, in spite of some of the erratic stuff in the United States. We had this phenomenal 2014, and oh, by the way, 2013 was pretty good, 32, 29, really good returns, and look at those 5-year numbers. We're up 15% compounded annually in the stock market. In March of 09, we will end up with 6 years of up market, 6 years of up markets. And this compound rate of return of 15% is pretty amazing. And by the way, during 2008, 85% of investors, when that market was falling 50%, 85% of the investors didn't bail out of the market. They were scared blankless, and they held on, and this is what they've gotten as a reward. They're all the way back from where they were, and they're a little bit ahead of the game with this compound rate of return. 10-year returns, which would take you back to 2005, still pretty close to the long-term average for stocks. Stocks do 8 or 9% over their entire long-term 80, 90, 100-year history. So pretty decent returns out of the equity side of the equation, in large measure for some of the reasons we just talked about: corporate performance, consumer performance, and some of the tailwinds we've had this year from oil. So I'm just going to say by the end of the month, the Dow will be at 20,000. You can all leave. Even in a short month, Ed. Even in a short month. Can the bull market continue? Natural question, right? We're coming up on 6 years at the end of March. March of 09, you could have bought GE. Did anybody know what GE bottomed at? $5. $5. I was on TV with the CFO of GE in 2009. I was on CNBC. I was on right before him. My segment was 45 seconds. His segment was about 15 minutes. And they ran the real stock price of GE as he was being interviewed, and the stock was going down every second he talked, and I said, get off the air, get off the air, get off the air. But you could have made a fortune buying GE at $5 a share, or buying Whole Foods at $9 a share when it goes to $100 a share. So it was a pretty remarkable time, but now we've had this 5 or 6 year bull market, and people are beginning to wonder, is it getting a little long in the tooth, so they take some chips off the table. So this is very busy, but I'm just going to tell you what this is. We went back and we looked at bull markets from 1913 forward, when I had just started my investment career. And we came all the way forward to where we are. There have been 14 secular bull markets in that period of time. This one ranks 4th or 5th in terms of length and in terms of percentage gain. So there have been longer. This one is long, I won't deny that. This one has had a big percentage gain, I won't deny that. But it's not the longest by any stretch of the imagination, or the biggest in terms of percentage gain. So people say, well, I'm still kind of nervous, Sandy. I look back over my shoulder, 2008, still a pretty dark shadow that it cast on my psyche, and I'm still a little nervous about things. But the reason to get nervous about stocks isn't so much how long the market's gone. I mean, I remember 93, 94, 95, 96, 97, 98, and 99. I remember all that. I remember those were back-to-back years of good markets. The reason to get concerned about the stock market is when it gets overpriced, when we're paying too much for stocks, when we're just carried away and we're willing to pay any price to buy a company regardless of how much profit it's making. And that's when you get concerned. Or when profit margins are deteriorating, which they're not. Or when companies aren't paying you more in dividends, or when companies aren't investing in themselves, or when they're not seeing company sales grow. We're not seeing any of those characteristics. So if you look at what we call these fundamental and valuation factors, they're more important about telling us whether or not to have confidence about the stock market. And let me just give you one measure of that. It's called the PE ratio. Price is the numerator, earnings is the denominator. In the United States, over a long period of time, we pay about $17 in stock price for every dollar of earnings in corporate America, okay? So that PE ratio is 17 in that example. It would take 17 years worth of earnings to equal the price we paid for the stock. Everybody with me? Right? Long-term average in this country is about 17. Now let's just take a look at what it looks like right now. This is a hard chart to read, but basically we're sitting at about 18 times earnings right now. And in 2000, where you see the peak in this graph, we were paying over $30 in stock price for every dollar of profit. And we should have sold out before the tech bubble wrecked us in 1999, 2000, 2001, because PEs were sending us that message. Technology stocks in 1999 were selling for 100 times earnings. Hello? Sandy, don't you think you should have gotten out of the tech bubble? You saw those high valuations? We don't have those kind of warning signals here. And we not only don't have them here, we don't have them in Europe either. And Europe stocks are a little cheaper than ours, but they're right at their historical norm of about 15 or 16 times earnings. So the story, and if we looked at Asia Pacific, which I didn't bring along, they're right at their historical norm. So the global stock markets look kind of on that single measure, they look reasonably valued. What does that mean? Are they screamingly cheap? No, they were at 10 times earnings in 2008. We had a great big rise, and the work's going to be harder going ahead. You're going to have the right stocks, the right sectors, the right countries to make money, but it's still going to be available. We think the markets are not ready for some significant pullback. So switching that from U.S. equities to U.S. fixed income, this has been the market that surprised everybody in 2014 because we expected interest rates with an improving economy. We expected interest rates to go up, and they went down. And bond prices go up when interest rates go down. So most investors, including BMO, we were positioned for a correction in bond prices, meaning that we would see a rising rate scenario and falling and rising interest rates and falling prices. But we got the opposite. Fortunately, we had straddled our bet a little bit at BMO, so we managed to cover through that okay. Here's the 2-year Treasury, the 10-year Treasury, investment-grade bonds, high-yield bonds, adjustable bank loans, EM debt. I'm only going to really focus on the top two, the Treasury. So this is our nice, safe U.S. Treasury, right? So here's the U.S. Treasury. We all expected the year started with Treasury rates at about 3%, and they fell to under 2% during the course of the year. So look at this return for that second line. Look at what our good old U.S. Treasury return gave us. Interest rates went from 3 to under 2, and we got a 10%, nearly 11% return out of good old safe U.S. Treasuries. Why in the heck did that happen? The economy was improving. We might have seen interest rates go up, but they didn't. Why didn't they go up? Because people rushed to the U.S. Treasury market and demand for Treasuries went sky high. And when demand went sky high, guess what happened to prices? They went sky high, and yields went that way as a result. And that's what happened. Well, who provided all that demand? Non-U.S. investors. If I owned an Italian bond and a Spanish bond, guess what? It was paying me the same interest or less than I was getting from the U.S. Treasury. So why would I own the Italian credit or the Spanish credit when I could own the U.S. credit and get even a higher interest rate? Does that make sense to you? Yeah. So the volume was enormous, and up went the demand and kept the prices high and the yields low, and we get this nice 10.7% return. 2-year Treasuries were kind of flattish, and you'll see in a minute why that's important. And here's the 5-year record. But look at 2013, that 10-year Treasury, instead of being positive 10 or 11%, was negative 7%. That's Bernanke making the speech, you know, the things are getting better, and we're going to have to start to get off of quantitative easing. He made that speech. People assumed interest rates would go up. They did go up. They went from 2% to 3%. Down came Treasuries. We had a negative 7% rate of return. Altogether for 5 years, had 5 to 6% returns out of your Treasuries and some of the other instruments in the fixed income category for 5 years. That's versus our 15% in equities. So if you were a 50-50 portfolio, you had some pretty nice returns if you were 50% in stocks and 50% in fixed income. Now, I just want to show you how this happened, this 2-year and this 10-year Treasury. 2-year Treasury for the year is flat, basically, and the 10-year Treasury is up. This is really going to get to be bond managers are really sick people, by the way. You know, I had a bond department at Kemper. They were all clinically should have been institutionalized. And the reason is they love it when interest rates go down, right? Because prices go up and their category does really well, so they like that. But what makes interest rates go down? Weak economy. So when GM's announcing hundreds of thousands of layoffs, the bond managers are drinking cognac. Now, how sick is that? Pretty sick crew. So I'm going to get a little bond geeky here with you and just show you a couple of things. Here's the 2-year Treasury. It was yielding 0.38%, 0.4% at the end of 2013. It doubled. It's still a minuscule yield, right? But it doubled. It went from 3.8 to 67, not quite a double. And the return for the year was just for 2014 was 0.66%. Now check the 10-year Treasury. So the 2-year Treasury actually has rates doubling, but the 10-year Treasury had yields falling from 3 to 2 and giving us this big positive return. This is very unique, and here is another opportunity for a cocktail clincher. On the balls of your feet? Non-parallel shift in the yield curve. Come on now, non-parallel shift in the yield curve. Don't be so quiet in the back. We can hear the altos. Okay, that's it. So that's kind of a geeky thing to point out to you. This is probably the most challenging area right now. It could potentially be there aren't a lot of cheap assets to buy right now. We saw stocks are fairly valued around the globe. There's nothing screamingly cheap. Bonds, quite truthfully, look overpriced. Because if you believe the economy is going to get better, that the global economy at least will hold its own and muddle through, eventually we're going to see rates head up, and that's going to be what? Good news or bad news for bond prices? Bad news. So this is really a dilemma. What we've done is keep a fair amount of powder short in case interest rates do go up, but we've also kept some powder invested in longer-term bonds in case rates stay depressed or go even potentially lower. So you're kind of covered. But at some point, there's probably a cyclical trend and maybe a secular trend to higher interest rates. Okay, so one other piece, because many of you may be individual investors and you own muni bonds, and it was an even better year for muni bonds. Muni bonds were up 9% for the year. And their yields went dramatically from that blue line. Yields fell on munis to that gray line. So, of course, interest rates going down, bond prices going up. And muni land was a fantastic investor. So if you were investment vehicle, so if you're in the muni side, you had a pretty good ride. So U.S. storyline, lots of tailwinds, consumer, corporate, oil, valuations reasonable, some hard work ahead for stock selection, but still opportunities. And clearly on the fixed income side, you're going to have to be pretty adroit and pretty mindful about how you position a portfolio on the fixed income side. When we go to the developed world, we call this EFA. Stands for Europe, Australia, and the Far East. Asia is primarily Japan in this. It's all developed countries, no emerging market countries in this index. Here are the returns for Europe. That's the stock 600, like our S&P 500. That is for Europe. The Nikkei, Japan, and then that EFA index. The returns for the year, other than EFA, were okay. They're not as good as the U.S. But for me, when I think about how monotonic and moribund the European economy looks, I don't know how in the world Europe managed to get an 8% rate of return when you think how sick the economic performance has been. So stock investors who tend to look ahead may be seeing things coming. Maybe that stimulus that the ECB is going to do is going to have an impact, and stocks did okay. And certainly they did okay in Japan, and then the EFA, primarily Canada and Australia, really dragged down the EFA index. Look at 5 years and 10 years, nothing like what the U.S. has done, but not bad, 10% in Europe. We got 15% in the U.S. The Nikkei has a 12% 5-year number, but largely because they were up 60% last year. And so it's a very kind of a disappointing number in aggregate for EFA at 5% compound rate of return for Europe, Australia, and the Far East. I will tell you right now, we're looking very hard at Europe. We have a little bit of money in Europe, but we're starting to think that maybe that stimulus program and a few other things that we're looking at might start to get some traction. We'll show you that in just a second. So that's sort of the developed world very quickly. And then if we go, let me back up for just a second if I dare, and set this up a little bit. So one of the things we look at when we look at economic performance in a country is their manufacturing activity as well as their service activity, right? Big components of any sort of industrial major economy, both the manufacturing side. And there's a survey that's been done for decades that surveys manufacturing activity and service activity across all the major countries of the world. And it's a very reliable survey. And when it reads over 50, it means things are expanding in manufacturing. Things are expanding in services. When it reads under 50, it means things are contracting. And it's had a very, very good track record. The western part of the economies, United Kingdom, I'll call them Anglo-Saxon economies, United Kingdom, Canada, U.S., manufacturing service numbers are unbelievably good. But when you look at Germany and you look at France and you look at the European Union, the numbers continue to be both weak and getting weaker. So this, I'm not going to have you expect you to be able to read this, but this is the U.S., this is Canada, and this is the United Kingdom. These are the service numbers and the manufacturing numbers, and they're basically telling us things look better, above 50, getting higher. United Kingdom's at multi-year highs. We were at multi-year highs a few readings ago. And in Germany and France, we're getting numbers in the European zone that are running at 50 or below, and in some cases, the trends are the wrong way. So you say, well, Sandy, what in the world is giving you any encouragement about potentially putting money to work in Europe? And the reason is because there is so much money that is being thrown at this that we're starting to see lending pick up. And one of the first things you look for a turnaround in the economy was one of the very first things that turned around in the U.S. You look at U.S. lending activity right now, it's been unbelievable. Commercial, industrial, individual, and there is a lot of bank lending activity going on. And the first symptom of increased lending activity is the banks have to be willing to lend. And the second piece is borrowers have to be willing to borrow. And in Europe, nobody was doing anything. Banks and lenders weren't shaking hands. They weren't walking down the aisle. They weren't inking deals. And the credit standards were incredibly high. You came with wanted $50 loan, they demanded $50,000 of collateral. And that was kind of how tight it was. It was that old Ferris Bueller thing about comes out a diamond, goes in as a piece of coal and comes out a diamond. Okay, but guess what's happening? The bank's credit standards are starting to relax. And the banks have gotten through, for the most part, a very rigorous stress test from the European Central Bank, saying most of the banks in Europe, the vast majority of the 600 major banks that the ECB oversees, got through this stress test without any serious problems. 2 or 3 had problems, but those problems were fairly limited. So now we're starting to see that gray line that's going up is the lending standards easing. So the banks are starting to say, hey, come in, borrow some money. We're willing to lend to you. So the next piece will be deals that are getting inked and people that are starting to invest. If we looked at some crazy minor statistics like auto registrations and auto sales in Europe, as just sort of an indicator, they're starting to rise. They picked up fairly significantly over the last 2 or 3 months. So it may be a little early. We may need to see some more evidence, but certainly there are some signs of hope here, and that would be a huge tailwind if they're able to avoid going back into a recession in Europe. Going over to China, obviously a King Kong player. The numbers have been very, very disappointed. Do 2 indexes here. You can't invest in the Shanghai index. There is hope that this index will eventually be translated and moved over to the Hong Kong market, and we'll be able to get to it, but only mainland China can invest in this. And the mainland China investor loves to speculate. And they used to speculate in real estate, and now they like to speculate in stocks. So take a look at how the Hong Kong exchange did, Hang Seng, versus the Shanghai did last year. Yeah, really? You sure you can't get this market open for us? Up 60% in the Shanghai composite, up 5% in Hong Kong. Chinese stocks in general and equity markets in China have in general, for the U.S. investor, been a disappointment. This is the number for 3 years, for 5 years, and they're pretty disappointing results. And there are good reasons. There are 2 or 3 things critical to China. The first big thing is China needs to go from being an export country to being a consumer country. And they're working hard to do it. They used to be 35% consumption. They're moving over 40% being consumer driven. They want to get away from you turning the label and saying made in China. And that's a very difficult transition to make. So that's number one. The second concern is, can they sustain a growth rate at 6 or 7%? Because we're kind of counting on that. And it's hard for them to do it right now. They're stimulating their economy to try and keep that growth rate up. And then the 2 other concerns are kind of one general category: credit concerns about China. Credit concerns about housing, and credit concerns about what we call shadow banking. So I'll just show you those very quickly. Shadow banking is like our money market fund business. These are products that are offered by trust companies in China. They give the impression they're guaranteed, and if you put $1 in, you'll get $1 out. They aren't really guaranteed, but they give that illusion, and they give very attractive yields. And the problem is this shadow banking has gotten to be a huge activity. It is now 126% of GDP, total economic output. And some of these customers have said, hey, I'd like my money back, and I'd like that interest rate you promised me. and they didn't get their money back, and they didn't get their interest rate. The Chinese government stepped in on a couple of them, but let a few others go under. This could be a big financial crisis. If it moves from concern to crisis, it's going to be a pretty ugly crisis. And there's one other one that's brewing out there that you all know about, and that's the real estate. Love that play on words, shaky hot foundation for real estate. This is basically, China pumped a bunch of money into real estate, and they have 70 cities with over 1 million people in the city population. Prices were rising, people were buying second homes, third homes, very little money down, and the real estate market was booming, and prices just rose like crazy. China saw this coming, and they said, you know, we're starting to get a bubble. Bubbles almost always turn into bubble baths, and they wanted to avoid that. So they did more than tap the brakes. They said, no, you can't buy a second home. You can't buy a third home. No, you can no longer do this on very little down. You need 60% down. And so investors actually, in my view, what they did was they left the housing industry and they went to the Shanghai Stock Exchange and started to speculate there rather than the housing. So that's what I think is being reflected. And now you see that's all vacant space that's available and waiting for occupancy just in the residential market. And prices, if I put up prices, they've gone down every month in every one of the 70 cities for 7 months in a row. Prices are down. So hopefully they're able to more than just tap the brakes, but slow both of these and keep these as concerns rather than crises, because if they turn into a crisis, it won't be good for the global economy for sure. Emerging markets, this is kind of 21 country index, and the big players in the index are the BRIC countries, Brazil, Russia, India, and China. So that's the BRIC index. MSCI, about 60% of the EM index is made up of the BRIC countries. So how the BRICs do really sort of drives how the index does. Look at those results. So if you had money in emerging markets, your U.S. portfolio is up 15 or 16%. You got a negative return in 2014 in emerging markets, primarily because problems we talked about in China. Brazil re-elected Rousseff. They've got real problems between the social agenda and the business agenda in that country. They have real corruption problems in the interaction between government ownership of some of the countries in Brazil and the way those companies are run. So Brazil's had problems. And the only one that had a good year this year was India. And what did they get? They got a brand new leader. So they elected somebody, the party that hadn't been in power for years and years and years. They elected him, Modi Narundo, and they elected him with a huge plurality. His BJP party took over, and they're in charge in parliament, so he's got parliamentary control as well, and he's got a very pro-growth agenda. They had him on for an interview a few weeks ago. I don't know if you saw it, on 60 Minutes, and then he was on CNN for a lengthy interview as well. Fascinating guy, very articulate, very progressive. Looks like a China playbook. He's going to take a lot of government money. He's going to try and clean up the water. He's going to try and get a good electric grid. Going to try and build mass transit. Going to try and get rid of some of the local corruption that goes on. Lot to do, but the market loved the sound of what he wanted to do. We'll see how it plays out. And then, of course, Russia, which is doing oh so well. Right? So Russia has had all of these challenges that have gone on. And by the way, the numbers for 5 years are not very impressive for emerging markets either. I will say this about emerging markets, and we have a little bit of money there, is PEs in this country, 17 or 18 times earnings. PEs in Europe, 15 or 16 times earnings. PEs in Asia and emerging markets, 8, 9, 10 times earnings. So from a valuation perspective, it looks pretty interesting. But we need to get these economies a little more on track to sort of confirm the story before we would start doing much more there. So the EM, the BRICS, we've talked about that. We've talked about, now let's just talk about our good friends Russia. Could they have done anything more to mess this up? I mean, this is hard to believe what they have done, really. And Putin doesn't seem to be blinking at all. And yet the economic consequences and social consequences have been enormous, both within and outside the boundaries of Russia. I will tell you, can I tell you one more quick story? Is that okay? This is a story about Ronald Reagan. Remember the old Soviet Union and Gorbachev? Remember those names? Anybody? Yeah? Okay. So Reagan tells his story about meeting with Gorbachev, and he says, I just want to see if this is true, Mr. Gorbachev, and it was Reagan telling the story. And he says, I heard that a woman came into the auto dealership in one of the Russian towns, Soviet Union towns, and she wanted to buy this car called a Lada, and didn't have a very good sort of operating history, and she wanted to order a new car, and the dealer was trying to talk her out of it. She said, no, I really want this Lada. He said, okay, but he said, you know, it's going to take, you're not going to get your car till March 17th, 2 years from now. And the lady said, morning or afternoon? And the dealer said, why do you ask? And she said, well, I have a plumber coming in the afternoon. Russia's economy, it was a long way to get to this chart, I admit. But Russia's economy has really, really struggled, for sure. And when you look at both the incursion into Crimea, then you look at the economic sanctions, round 1, economic sanctions, round 2, economic sanctions, round 3, which have been severe and are really constricting Russian activity. Of course, oil prices have fallen dramatically, which is 70% of their economy as well. So the oil prices are way down. They're in the middle of a recession after having growth last year of 2 to 3%. They're now in the middle of a recession. Inflation is rampant. The central bank has raised interest rates to 20% to try and keep money from leaving the country, and capital is still flowing out. And Putin still looks in the camera eye and does not blink, goes to the negotiating table and does not blink. I mean, they're meeting today. I'm not sure if the meetings go on until tomorrow. As of noon when I came over here, there had still been no big breaking news about the peace talks they're having today in Europe on this issue in the Ukraine. But take a look. That's the Russian stock market and the Russian ruble. So if you're a real contrarian, good luck with this. But that's been very difficult. So if you look at now what we've talked about, we've gone all the way around the globe. So we started with a tailwind, global tailwind of oil. Then we went to tailwinds in the U.S., consumer tailwinds, employment, job creation tailwinds, reasonable valuations, bull market side of the story, concerns about the fixed income piece. Then we moved to Europe, where we're getting a little more optimism and a little bit on what's going on in China and the emerging market space. So if you say to yourself, Sandy, just bring this to a bottom line and tell me what we expect U.S. stock markets to do, which is kind of where a lot of concern is or interest is. Let me just show you a hypothetical way to do this, and then we'll wrap this up and take some questions. I'm going to show you 3 scenarios. The first one is the earnings that we expect the S&P 500 to earn a share. Last year they earned about $116 or so a share. It looks this year like they're going to get about 6 or 7% increase to 123. If we keep our PE, right, the price to earnings ratio at 18, and we do all the multiplication to give us a new number, and we subtract the prior year-end number for the S&P, we get about an 8% rate of return. So absent any other geopolitical stuff, absent any other interplay that goes on, admittedly, this is a very narrow way to look at it, we'd get ourselves a nice high single-digit return. Would we take that? Hey, when bonds are paying 2, are you joking? I'm on board. If you can give me a guarantee on 7 or 8, I'm in. I'm in. That would be fantastic. And that's fairly doable if we just keep the PE there and we manage to get a 6 or 7% earnings growth rate for corporate America. However, to just show you how fully valued stocks really are, if we keep the earnings the same, but people aren't willing to pay up as much, and we have earnings PEs contract from 18 to 17, we go from an 8% return to a 2% return, at which point, it's a little more problematic as to whether or not you're interested. And for those who would dearly love to keep the double-digit story alive, scenario C, where we get a PE expansion, which you could vision. I can vision PE expansions going from 18 to 19. Why? Margins are good. Consumers hopefully going to consume more, which means sales will be good for corporate America. Corporate America gets stronger sales. They can protect margins, protect profit margins. People will pay more for your stock. So the stock price goes from an 18 multiple to a 19 multiple, and you end up in that scenario with a double-digit return, much like we had this year. Okay, so that, is it 6 o'clock? I was supposed to get you to the 6 o'clock news. All right. Show you how we're positioned. More attractive to less attractive. And just this is real generic and real macro, big picture stuff. We like U.S. equities. We're overweight U.S. equities. We are looking, and I tell you this, we're looking very hard at the European side, and we may, in fact, be in the midst of sort of the final series of discussions about whether we do or don't move that needle over to a more attractive category. Emerging markets, we're still a little reluctant because we just are concerned about the economic profile of what's going on in China in particular. So we're probably going to stay a little bit cautious on the emerging market side. Fixed income, look at how we have an almost max, where we're really concerned. And we still are with this, what we call this strategy where we have a little bit of money on short maturity bonds, a little bit on long maturity bonds. We call it a barbell strategy. You can sort of envision we have about 40 or 50% of our portfolio defensively structured, and the remaining on the other side of the barbell much more aggressively structured, We're still set up that way coming into this year. The nice thing about calling it the barbell strategy is if it goes wrong, it's an easy name switch. Okay. So that's kind of, we're nervous about the fixed income side of the equation. We're getting progressively more concerned about the junk bond area of the market as well on fixed income. So that's kind of the simplified scorecard. And then, because we need to have one really good closing graphic to wrap this all up, one that really sort of summarizes it all, there it is. That's good, isn't it? That's all our disclosures. I'm the only one in the company that shows this slide. And so I'm going to read this to you now. All right. Thank you. You are great, as always. Rapt attention. This is by far my favorite audience, because first of all, I know a lot of you and know you first name basis or whatever, and secondly, it's just a friendly, bright group. So happy to take some questions, and the harder questions I'll defer.
Sandy, I was going to say, for those that have to leave.
Sandy.
2 questions, please.
How about that? 2 Sandys in the room. The first one's no.
Russell 2000.
Uh-huh. Russell 2000.
Value stocks.
Value Russell. Okay.
Under return the rest of the market. Where do you think they stand right now in terms of your model?
Okay. The small cap space, we're generally underweight a little bit. The value space, we're generally overweight a little bit. So in the small cap space, first of all, small cap stocks tend to react the most positively when interest rates go up. They respond more aggressively than big companies do. So we like the category. We're a little underweight the category. We have money there, and we like value more than growth in that category.
Second question, if you have a portfolio that might have been previously overweighted in oil stocks, have taken a big downturn, obviously. Is this a good time to take a look at the oil stocks? Do you think this is going to be depressed for a lot longer?
Well, this is a great question. Is the energy drop in energy prices, oil prices done, and therefore a good time to bottom fish by some of the energy companies at depressed prices? I think if you have always with investment, one of the things I always caution people is marry a time horizon with your investment decision. So if you tell me, should I buy oil stocks in here? My question is, how long are you prepared to hold them? Because I don't know when the bottom's coming in oil. Maybe it's 45, maybe it's 40. Maybe it's 35. The Saudis make money at 30. I can tell you deep sea drilling doesn't make money under 100, and fracking doesn't make money much under 90. So the Saudis, there's some rumor that the Saudis have actually been manipulating the markets and allowing them to go down, forcing the competitors to lose money, stop their expansion plans, and kind of limit their ability to kind of expand because prices don't support those kinds of economic decisions. So there is a rumor out there. The second piece is a lot of people say this is a supply and demand issue. Oil prices went up. We were able to justify investing in deep sea drilling, fracking. Oil prices went up. Now suddenly they're not there. Supply went up as a consequence, but demand didn't go up as fast. So what we really have going on fundamentally, oversupply and lower demand. Increasing supply, lower demand. That's the sort of the consensus view. The reality is the demand numbers appear to be a year out of date. And we don't have this confirmed yet. We've been doing some research. We talked to a research firm that's looking at this. If that's true, and the demand numbers are significantly or at least marginally higher than people expected, the demand-supply story might not be factual. And if that's true, then energy prices will start up relatively soon. And, but if you were to say, can I buy some of these companies at these prices and 5 years out or 10 years out, be glad I own them? Yeah, probably. Wouldn't promise it for the next year, though. Yes?
You seem pretty comfortable with margins, even though they're at relatively historic highs.
Right.
But last week, Procter & Gamble had a pretty ugly miss based on a currency translation. Are you at all concerned about a rising dollar and corporate earnings?
Yeah, great question. So the dollar has risen, and of course the euro has plunged from 135 or 140 down to wherever, and the yen has plunged as well from 74 to 100 and whatever. So yes, we are concerned about the strong dollar. The interesting thing is, if you look at strong dollar in history, actually large cap stocks do pretty well. It's hard to believe that they do, but large multinational companies that have a fair amount of exposure to Europe and non-U.S. sales in Asia as well, they actually do pretty well. And you say, well, why is that? And that is because companies have gotten extraordinarily good, not only at executing, but at hedging and hedging the currency bet. So what we think has actually happened, and I'll tell you, this is a speculation in terms of our answer to your question, but the speculation is that the executives at these companies that do know how to hedge currency risk, so the guys at P&G do know how to hedge currency risk, and they didn't see the quick, dramatic shift in dollar leadership. But that by the time we get to the second quarter and the third quarter, you're going to watch those adjustments for non-U.S. earnings and the currency effect get minimized because they'll go into the hedging strategy. So that's sort of our take on it. But you can go back. There have been three spikes in the dollar. The current one we have. There are two others that are fairly recent history as well. And stocks actually, and large cap stocks, did surprisingly well. And large companies tend to have more exposure to non-U.S. sales than smaller stocks do. That's a great question, though, Tim. Another question? Best stock to own for next year? Matt. You know, the MLPs and preferred stocks. I mean, one of the real cases here, as you know, Matt, is the search for yield. And one of the things that's worried me about bonds and therefore made me a little more comfortable with MLPs, maybe a little bit more comfortable with some of the other ways to get a nice income, which MLPs will do for you, preferred stocks will do for you, give you a higher level of income, is that people started to chase yield, in my view, in categories that were very risky. So instead of doing the MLP, instead of doing the preferred stock, they said, you know what, I'm not going to buy treasuries, I'm not going to buy investment grade corporates, I'm going to buy junk bonds. And they got themselves 6 or 7% yields on junk bonds as opposed to 2%, and they're licking their chops. And in fact, they got very good performance. Not only did they get the income, they got a double-digit return. The problem is that junk bonds, in reality, are common stocks wearing a mask. I mean, they are highly correlated to U.S. stocks. They're just about as risky as U.S. stocks. The correlation between their prices and stock prices, as you know, is very high, 0.9, 0.95, perfect correlation being 1. So, but again, it's down to the specifics, Matt. I said the hard work now is you could have bought stocks in 2009, bought yourself an S&P index fund, and it was going to lift the ships 15% a year. Great. Now, we think the game has changed. You're going to have to own the right stocks, the right sectors, the right countries, potentially hedge or participate in the currency. And the same point on preferreds and the same point on MLPs. You need to do the hard work of which ones to own, for sure. Because some of those MLPs are a little less interesting than others. Yes?
Sandy, asset allocation has a lot to do with portfolio performance, and you've suggested underweighting fixed. For how long?
Well, you know, that's a great question. So, and just to reiterate what you said, because it's an important lesson for all of us to remember, asset allocation, how you mix stocks and bonds and real estate or whatever else you might have in your portfolio, is a longer-term biggest determinant of longer-term results. So my concern about bonds is that right now, if we have had a multi-year period of declining interest rates. Now we seem to be going through a period of what I'll call flattening interest rates. And I'm wondering if we start to get the global story, if China doesn't roll over, if Europe doesn't roll over, if we get just a little bit of growth out of Europe, and if we get the 5 or 6% out of China, if Japan catches a little bit of a leg, and there's some things happening in Japan that look encouraging, and rates start to turn this way, that we could have a secular period where rates move up. Now, our view collectively right now is that the Fed will start this move up in rates, assuming nothing changes from here, that the data should support a move either in June or September, and the move will be very small. Now, and the second move is like 1/8 of a point, which would be really unheard of. Normally they do quarter-point moves, and normally they do them sequentially over a period of time. And then that's the Fed rate, right? Remember, corporate rates can move much more quickly. So if we got in that period, you might have 12 to 24 months where you could be reasonably defensive and probably be hurt and have yields continue to stay where they are or even move lower potentially. But we do think the secular trend is probably on the upswing for yields, at which point you want to start being ahead of that curve and getting either more defensive in your fixed income or start to change how much you have in fixed income.
What sectors would you see yourself investing in the next year or two?
Okay, it's a good question. There are 10 sectors in the market. They range all the way from technology to utilities, from using the sort of the more aggressive to the most conservative, if you will, in terms of valuation. And then you've got the majority of the stock market's tied up in 3 or 4 sectors, however. Utilities and telecom sectors are relatively small. The materials sector is relatively small. You have less than 5% in a couple of those sectors. But you get up to the biggies, which is where most of the asset allocation is by sector, and you have technology up there, you have healthcare up there, you have consumer durables up there, industrials up there, consumer discretion staples up there, the P&Gs of the world and up there, and those really are the biggies. The one we like the most right now is actually technology, and it's interesting to see the best 2 performing sectors last year were technology. Does anybody want to guess what the technology was actually the second best performing? Best performing, anybody? Ignoring REITs as a sector because they're not really technically a sector, but REITs were substantial gainers. Second one was? No. Utilities. Now, what odd bedfellows is that? So you have your most defensive sector, highest dividend yield, having the best performance, like up 23 or 24%. Technology was up 20%, Matt, maybe? Something like that, 19%. And yet the PE ratios are identical. And in fact, for utility companies, because demand went up for utility stocks, right? Want to buy utilities, suddenly you're paying 19 or 20 times earnings to buy a utility company that is loaded with debt, heavily regulated, and ain't growing in earnings. Just to get the dividend yield? Really? Really? So technology to us is our favorite. We like healthcare. A lot of these sectors, like technology and like healthcare, are 2 good examples. They're splitting in 2. They have a split personality. So you look at healthcare, we talk about Pfizer, that's one kind of company. We talk about Gilead Sciences or Celgene that are doing, biogenetics and life sciences, completely different. Those are very aggressive companies, big PEs, whereas the Pfizers of the world and the Mercks of the world, they're all struggling, have much lower PEs, nice dividend yields, but much lower PEs. Same in technology. Old world technology, Microsoft, Cisco, old world technology, never used to pay a dividend. Now you get 3.5% dividend, whatever, from those companies. And then you have all the social media companies on the other end of that spectrum, cloud computing companies on the other end of that spectrum. So it's hard to generalize. So we say technology did well, but it begs the question, what kind of technology? So these sectors, you have to kind of break down. Those are the 2 that are the biggest ones to break down, healthcare and the technology sector. We like healthcare. We tend to be a little bit more on our mix is a little more on the conservative side, but we do have exposure on the aggressive side of healthcare. Industrials we like because if you have a cyclical recovery in the economy, industrials should participate as well. So those would probably be our 3 favorite as we head into this year. All bets are off for next year. I do. It went bankrupt. I think I told this story before. I will tell it to you. Myself and 3 buddies, when I had my first job at a bank in Chicago, we were in the research department. And we went out one night and we said, you know what, the heck with all this diversification stuff. We're young kids. We're going to find one stock and we're going to invest all of our disposable income in that one stock. And we found a stock that was working on a cure for arthritis. It was being tested on horses because thoroughbred horses have huge hip problems, joint problems. So they're testing this drug for arthritis in horses. They had 100 horses getting the drug, 100 horses getting a placebo. And the stock was trading at it was on the pink sheets. It was trading at 40 cents a share. And we're piling between the 4 of us, we're piling and I was making $7,200 a year. And my buddies were making the same. But we're plowing $100 a month from each of us, which is big money, after taxes at that point. And every time we got a raise, the money went in, and we just kept buying. It went from 50 cents, went to $1, to $2, went to $4, eventually went up to $14 or $15 a share. And we're all going retire at 55, retire at 50, retire at 45. And then on one day, not over a week or a month, all the horses that were getting the drug died. And I have about 375,000 shares. If you're interested, I'll put it on eBay and you can hit the bid. And so that's my story on stock picking, and that's why I'm a strategist now rather than a stock picker. I do have a favorite stock, but I'm not going to, it's already underwater. Okay, well, you guys have been great. Have a good rest of the day and rest of the week.